Hey everyone, Chris Haddon, Jason Balin, co-founders of Hard Money Bankers. Check us out, hardmoneybankers.com and Facebook/hardmoneybankers. Today we are discussing the 5 different ways you can finance a real estate deal.
A lot of people in real estate don't realize there are so many different ways to finance your projects, and not just banks or not just your own money. There's a lot of different ways, and we're going to go through them all right now. Check it out.
Here's the thing about real estate that kind of creates this problem of people not knowing about all the financial options is that real estate's a huge industry. There's many different aspects to it. Like you have residential investors, for example, and the financing that's common with those. You have homeowners, of course, buying properties and the typical financing there. You also have big commercial stuff and the complex financial structures that come into play with those kinds of projects. And part of the problem is that people just get stuck in their little niche, like people tend to do with many, many things. They get stuck in their own little bubble and they don't know that all these other kinds of financing options exist. So we want to break them down.
Exactly. Let's just quickly go through the cash one. We understand that a lot of people don't just have the cash to go out and buy real estate, either as a primary residence or as an investment property. If you do, kudos to you. Absolutely, that's great. Investors in general, save your cash, use your cash for maybe gap funding or to make monthly payments on the deal. We've always had a philosophy as if you had $100,000 in straight cash, do you go and you buy one property, or do you kind of break that up and maybe buy 10 properties with $10,000 down payment on each one of those? So don't spend too much time on it, but if you have the cash and you don't have any other way to deploy that cash, absolutely maybe put it into deals. Just remember that your cash does deserve a rate of return on it, and you have to treat it like that.
Yeah, I definitely agree with that. There are certain times when buying in cash is a good thing, but leverage is there for a reason, and smart investors use it for a good reason.
And use the available cash that you have and lever it up a little bit with one of these other creative financing sources that we're going to use, and then use your cash to bridge the difference. The next one is banks. Obviously, we're going through the two most most common ones that people think are out there. So, there's pros and cons of using banks. Obviously, they're harder to deal with. They're not as flexible. You do need full financials, tax returns, things like that. It's a full doc loan program. They don't really like dealing with real estate investors as much. They require large down payments, things like that.
Tons of documents, long time frames, like all kinds of stuff.
But the big benefit of banks is they're cheap. And a heck of a lot cheaper than anything else. And right now, like you said, they're cheaper than ever. And they have jumped into the investor transactions, and the down payments aren't as much as they used to be. So the bottom line is this: if you have a property and you don't need to close on it tomorrow, maybe it's not an auction property, maybe you have 30 days, you do have decent financials and good credit, and you do have some cash to contribute, and you're looking for really easy, lower terms, that's the way to go.
Yep, banks certainly have their place and a big part of the market for that matter too.
Okay, so number 3 are private investors. Now, private investors are very common in the real estate investing space because there's investors out there that want to deploy cash at a higher rate of return. Yeah. A little bit harder to find the private investors, unless you're in that sphere or that circle where they are. It's not that hard to find it on a small scale, but if you're looking to scale up a real estate investment portfolio or you're buying larger commercial properties, it takes a little bit more time to do that.
Yeah, and that, just to jump in for 1 second there, the private financing, as we've described it, can be a few different things. Like it can be individuals. Well, first of all, it can be debt or equity. That's an important part too. Yep. Like people can be a partner on the project and come in cash that way, or they can give you a loan, debt, which is very, very common, especially in commercial projects where you'll have like your money as a sponsor, and then you'll have some equity coming in from cash investors, and then maybe some other kinds of debt, and then maybe a bank loan. Like it could all be mixed in there. So yeah, private investors can mean a few different things, and you're right. Like if you're not in that world every day, it seems very foreign, but it's a huge market.
Yeah, exactly. There's a lot of private financing, even on homeowner loans, investor loans, commercial loans, whatever transaction. There's a huge private market for that. And the big benefit of dealing with private investors is there's a lot of flexibility related to it. Is you can kind of structure with them as a partner of how you want to do this. The biggest thing, though, that we see that I feel like it's extremely important, ethics-wise, is to be transparent with the private the private investors, especially if they're an unsophisticated private investor, because they're giving you money, they're partnering with you, and you need to make sure they're getting taken care of and getting the return that you're promising them.
For sure.
Number 4, our personal favorite, hard money lenders.
Hard money lenders, bridge lenders, private commercial lenders. They go under different names, sort of, but it's all basically the same thing. It's, in essence, doing debt from private sources instead of institutional.
Exactly. Now, the benefits are they're usually pretty flexible. You can usually get a higher loan to value, even though it's straight collateral based, just because they're basing it, if there's a construction component on it, they're basing it on the after repair value, the completed value, and then there's some sort of construction play on it. They like construction loans, rehab loans, investor friendly, slightly more aggressive because they know the market. Not too many downsides of using a hard money lender. They're a little bit more expensive than maybe a private lender or a bank is, but they serve a purpose in the marketplace, and they're okay to do shorter term loans where a lot of these other financing types don't want to.
Yep. And number 5, what we are calling creative financing. Now, what would you say falls into the category of creative?
Creative stuff like subject to financing, assumable mortgages, seller held back seconds. There's a lot of different creative ways as a real estate investor, developer, anybody for that matter, or even a homeowner that wants to go buy a property and the seller has a lot of equity in it and they can't get full bank leverage. They do some sort of seller second. They do some sort of creative way to make the deal work, or just a hybrid of all of these combined is creative.
Sure.
I mean, there's a lot of times that someone will come to get a hard money loan, and maybe we do a loan of 150 grand and they need 30 grand cash to close, and they only have 20 grand and they get a private investor to put up 10 grand or whatever the case is. Or, it's the same thing with a bank. The bank puts up 70% and a private investor puts the 30% of equity up.
Right.
There's a lot of different creative ways to do this.
Those combinations are very common. Like you bring cash for closing costs and a little down payment. Then maybe you have like a gap fund or a private investor, and then you have either a bank or a private lender in first, so all three are rolled into one deal, which is very common, and it's certainly important. This may not fall into your niche in real estate, since like I mentioned, there are different domains in a big industry, but it's important to be aware of because you might cross over at some points in time, and then you'll be surprised by how the capital works. It's like, wait a minute, this is not a bank. We see it all the time when people get involved in investor deals, and maybe that's not what they do day to day. Or people get involved in residential stuff when they're normally used to commercial. We see different things like that, and people are surprised and taken aback by this kind of financing existing, and I think that's a mistake. It's a mistake to be unaware of important things like that in your industry.
Yeah, just like you said, be aware that there's a lot of different ways to finance all your real estate deals. The most important thing is having a good deal to begin with, and if you have a transaction that has some legs to it, there's always a way to get it financed. And I want to leave you with one really important rule of thumb. Whenever using OPM, other people's money, make sure that private investor always gets paid back first, and they're taking money out of the deal first before you are.
That's a good takeaway. Thanks everyone for checking it out, and we'll see you next time.
Thanks.